Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the SP 500 that is seeing a relentless move up here, a very powerful breakout here of this downwards price channel we've been trading in throughout the month of April and May. There are some huge developments happening on the charts right now. Underneath the surface, we're seeing big developments on the junk bond market. We've had some comments from the Federal Reserve. Just a huge amount of things to cover in today's episode, so we're going to get right into that. Right as the amount of bearishness in the market was really getting ridiculous, it was getting crazy. You just had to look at the comment section on our YouTube videos where we've been pretty bullish on the way down, right? We've been looking for a low to be printed throughout this move down. We've received a huge amount of criticism for that, and that just goes to show you that investor psychology has not changed and will likely never change. This is a chart that we posted just a few days ago on our website at gameoftrades.net showing the small trader put call premium that was spiking. Small traders were going all in into puts instead of calling for the market to go higher. A huge number of indicators were suggesting that the market was oversold here, overextended, too much bearish sentiment. And so that's when investors really lose faith in the ability for the stock market to ever rally again. And so here in just a couple of trading sessions, just these last couple of trading sessions, let's take a look at the weekly chart. We've retraced the last 3 weeks worth of market decline right here. 3 red weeks retraced in just a couple of trading sessions. And what I wanted to talk about in this video very quickly is that aspect on market psychology. And this is an article that I actually posted yesterday talking about the extremely poor returns we've seen on the financial markets, whether that's treasury bonds that are typically seen as a huge hedge against market volatility. We've seen treasury bonds go down 30% since January 2021. Now, I can't tell you the number of people that I saw throughout 2021 calling for TLT to go to all-time highs. We've seen this ETF drop 27%. Gold has been pretty much flat throughout this entire period. And so investors are looking at their equity portfolios throughout the past few months and seeing that they're in the red and they're getting very uncomfortable with their positions on the SP 500. But if you take a look at the returns since January 2021, so comparing those same levels, we've actually seen a 10% move up on the SP 500. And you can see what I wrote here in this article. If we're correct about a significant bounce coming on the SP 500 in the next few weeks, this percentage could morph into something much more impressive. And of course, since then, we've rallied another 2%, confirming the short-term rally that we're seeing right now. So I think, social media, the news, they can all make investors feel very alone in their positioning. Media outlets will post very bearish news at the bottom of the market and bullish news at the top. And so that's exactly why we have Game of Trades. Sometimes we'll be a little bit early on our calls. For example, here, we called for a bottom a little bit too early on the SP 500, but we stay focused on the data the entire way. We don't make irrational decisions. We try to stay as objective as possible and look at the data, look at the statistics, look at our research, and understand what the highest probability scenario is. And the reason I say that is because I've been through this. Being in the market is an emotional roller coaster. Things look horrible at bottoms. They can seem very obvious when you're looking back, but when you're at the bottom, things look absolutely disastrous, and you need proper research to make you understand what's going on. And so that's why we have Game of Trades. That's really the entire idea behind our service, and it's really what our members have been the most happy about. The fact that we do provide some sort of clarity and important information during these times of extreme uncertainty. Now, if we have to take a look at the best bottom indicator that we had for this rally here, and I always like to do that, what worked the best, so that we have an idea of what indicators are working right now, and that is the advanced decline line. Let me just add this on this chart. We clearly had a bullish signal here as the market was making a lower low right here, and yet the advanced decline line was making a higher low. This is an indicator that tells you the number of stocks that are advancing against the number of stocks that are declining. And so when you have divergence, it tells you a lot of stocks within the market are already rallying. And that really doesn't happen very often. And in fact, it works in the opposite direction. You can see right here, you have a higher high in the market. And as this was going on, you had the advanced decline line clearly tell us that we were not seeing follow through on this move. And again, this is something we were focusing on just a couple of days ago as we saw that divergence build. Advanced decline line, divergence with the advanced decline line can often mark important reversal points. And so clearly that's what's happened here. Again, this doesn't mean this is going to work every time from now on and that this is some type of a crystal ball you can use to know 100% where the market is going, but it gives you additional insight. And when you have so many people calling for much lower lows in the market just because it feels easy to do so when you've already seen a 20% drop in the market, we have to stay focused into what the market is actually telling us. Should we expect a collapse and a massive capitulation down? Or is the market telling us that we're seeing signs of an early reversal here? Now, what I really like about this move, and this is something that we're going to be focusing on in the next few weeks, is the move on junk bonds that we're seeing with this recovery in the market. And let me just show you that. This is J&K, the high yield bond ETF. And you can see what we've had over just the past few trading sessions. We just had this massive recovery on junk bonds, retracing again a large part of the move down we've seen. Now, that doesn't mean I'm bullish on junk bonds, but seeing junk bonds rally, it reminds me of these significant bottoms that we saw in the past in 2016, in 2019, in 2020. Very, very powerful move up in the junk bond market, telling you investors are all of a sudden seeking to take risk again, right? And that's a very, very different thing to anything we've seen right here. Ever since September 2021, we've seen junk bonds underperform steadily, except for a brief moment right here in March. This really doesn't look like a very convincing bounce compared to what we're seeing right now. So that's what I like about this recent move here. It seems convincing from a intermarket standpoint. If I add the SP 500 on top of this chart, you can see, of course, these all corresponded to big bottoms in the market, right? So we'll see what happens here. Past performance is not indicative of future returns, but again, it's an additional data point to consider and to talk about. And we're going to be diving deeper into this move here, whether it actually gives us anything really material from a statistical standpoint. We're going to be posting a few articles on that over the next week regarding junk bonds, whether that tells us anything about future market returns. Now, one more thing I wanted to mention in this article, in this video, is this article right here that I saw this morning. And that was that the Fed may pause policy tightening in September, Bank of America says. This is what we've been talking about for weeks now. We were very early on it, but it is materializing in a big way right now. Wall Street banks are for the first time talking about the potential for policy to not be that tight walking forward. If you remember, just a few weeks ago, just a couple of months ago, all these big Wall Street institutions were calling for increased rate hikes. They were all increasing the rate hike expectations, talking about the fact that the Fed was not being aggressive enough. And now, for the first time, we're really seeing that narrative reverse. That's being accompanied with the break-even inflation rate showing signs of rolling over, perhaps suggesting we're not going to see very, very hot CPI readings for May and potentially even June. And that's also as the 2-year government bond yield, which is a huge, huge contributor of market valuations and has been really the driving force behind this correction on the S&P 500. Let me just show you what I mean here. You can see the market really started to see its volatility increase when the 2-year yield picked up speed to the upside. And now that it's stabilizing, well, the narrative is changing, and perhaps you're seeing that selling pressure we've seen since the beginning of this correction subside for some time. Now, this is one of the things that we're going to be looking at very, very closely in the coming weeks. We're going to be posting a few articles on that, going into detail regarding where we expect the 2-year yield, the short-term yields to go, what that means for the Federal Reserve, and what that means for Wall Street and what Wall Street expects. Because at the end of the day, it's Wall Street expectations that really matter. If Wall Street expects the Fed to become dovish, the Fed is eventually going to follow through on that in the market, so Wall Street is going to front run it. If we see another spike in the 2-year with inflation expectations rising again, well, that would very likely mean that this rally that we're seeing here is going to turn into a bear market rally. In a similar way to what we had here throughout March, you had this rally in the S&P 500, and yet the 2-year yield was spiking here, telling you that valuations should contract from there. And so that's one of the things that we did not pay enough attention to right here. Although we did expect a pullback, we didn't expect it to be to this extent. And the 2-year yield could have given us additional insight regarding the extent to which the correction could have gone. So that's really what the focus of the next few weeks is going to be. I think we're well set here for a considerable run. We've had a nice bullish crossover on the daily chart. The market is coming off very oversold conditions with an extreme amount of bearish sentiment. It's breaking out above important technical levels. If you take a look at the next big resistance, I'd say this resistance line is very important to look at. So that would put the rally here at around 4,400 points. There's some big resistance here. And so how the market behaves from there, if it reverses or if it breaks out, it's going to be based on valuations, which is ultimately controlled by what's going on with interest rates, inflation, and the Federal Reserve, and earnings. And so if we go back to the S&P 500, and this is something that we've been discussing a few times over the past few videos, for those of you who are looking for a bear market like 2008 and like 2000, what you need to see for that is earnings collapsing, company earnings collapsing. That's what can bring the market down like this. If earnings roll over, then we can expect the market to roll over as well. And on Tuesday of this week, we're going to be posting one of the most detailed and thorough articles we've ever made in terms of the quality of the research that goes into this, really going deep into what we think about earnings. We go back in history, take a look at how similar the situation is to 2000, to the 70s, to the post-war periods in the 1940s and 50s, and we try and understand how similar these cases are to the current day and where we can expect earnings to go, and so whether or not we can actually expect a bear market, an earnings bear market, like in these two cases. Something else I'm looking at right now, what I like from the charts that we're seeing here, is the 100-week moving average here. The 100-week moving average has pretty much been the ideal bull market moving average for the past 40 years. For the entire bull market here, it's acted as a very important level of support every time the market snaps above. Sometimes the market briefly trades below it, but as soon as you snap back above it, the bull run resumes. Same thing in 1990, brief dip under, snap back right above just after. nice support level in 1994. And then once it's broken, when it's really broken, that's when you can see a big bear market. That's when you break down the bullish long-term structures on the S&P 500. And same thing again here in 2008. You even had a breakdown, retest, resumption here. That's a very, very ugly rejection here on that bull trap in 2008. Again, a few dips below in this bull market here. As soon as you snap back above it, you see a nice bull run form on the S&P 500. Again in 2019 here, brief dip below, snap back above it, makes a run at the all-time high. Again during COVID, brief dip below, although that was a big dip below. But when it snapped back above it, you see a run at the all-time high. So, right now, as I'm making this video, I'm filming this on Friday, we haven't seen the weekly candlestick close above the 100-week moving average. But if it does, that's a weekly bullish development. So, that's something to consider from a technical standpoint as well. And so if you want to have these frequent updates on the market, on the indicators that we're looking at, on the current macro view we have on the market, the research that we're doing, make sure to go and check out gameoftrades.net. We're really putting a huge amount of effort and time behind the service to try and make it as high quality as possible. And it's also incredibly accessible, for the quality of the research that we put out, the number of articles that we post. It's a very, very cheap price to pay. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to drop a like and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.